Welcome back to the Mountain Morning Show. Travis McGhee is here from FuturesANIMal.
How are you this morning?
Good. How are you?
Fabulous.
Good. I'm glad to have you here. I've got some questions I've been thinking about a little bit. So interest rates in general, very low, right?
Right.
Would this not mean that conservative investments are not having, this has a direct effect on them having a low yield?
Yeah, it absolutely does. You know, since 2009, with the financial crisis that we went through, which is obviously still on the forefront of everyone's mind, the Federal Reserve and the central bank, you know, took some extreme actions, extreme by historical standards, and you know, kind of unique actions to essentially drive interest rates down, which in essence forces people to seek higher yield elsewhere, and that higher yield they were hoping that people would find inside the stock market.
Right.
You know, because in 2009, if we all remember, you know, the stock market, you know, you look at the S&P was about 150% lower than, you know,
it was a mass exodus.
Yeah, I mean, it was nasty.
Right.
So it worked, right? I mean, if you look since 2009, the markets had a tremendous upward move over the course of the past 5 years. And, you know, there were a lot of reasons behind why they did it. Some agree with it, some don't necessarily agree with it. But in essence, they were trying to drive people into the stock market, and they were trying to get people to start borrowing money again.
It seems to have been, as you said, effective, though.
Right. It does seem to have been effective. Certainly effective for folks like yourself, folks like myself, my friends, my generation, people who are looking to buy a home. You know, we've had historically low mortgage rates. People who are heavily invested in the stock market, which tends to be the younger folk, people with more time horizon than others. What it has not been, or it has not done so well for, and has more or less been a detriment to, is the older generation.
Right.
Longer term, those who have been in the market for a longer term, but have a very short-term horizon ahead of them.
Which means that they were typically in implements or instruments rather that were much more conservative.
Oh, absolutely.
And of course,
you know, I look at my grandfather and even my father, and you know, they're later along in life, and they're certainly not playing in the stock market like they used to. A lot of, you know, a lot of their investments had consisted of CDs. You know, savings accounts, you know, stuff that in the past, you know, you could have looked at, you know, 5 to 10 year CD, and you know, you're upwards to 4 to 5% yield on it. Such is not the case now. Now you're looking at, you know, a couple basis points. You know, you look at the 10-year Treasury, which is what a lot of, you know, the 30-year mortgage and a lot of CDs and banks use as their pricing method, or at least a gauge. And you know, you're at, right now you're at 2.6%. You know, you're 2.7% probably today. So that's not a lot when you compare that against inflation. For a 10-year period.
This is where it becomes an issue, is it because many of these people, unfortunately, haven't changed their portfolio much, some, or at least some of them, and that means that they're actually losing money against inflation.
Right. When you look at it against inflation, again, we're not in a very high inflationary time period right now. That could certainly change, especially if you're locking your money up over a 10-year period of time. But this is something we talked about last week. You know, a lot of folks are like, well, yeah, I don't want to invest in the stock market. It's too risky, so I'm just going to go to all cash.
Well, that's definitely not a good idea.
They're good. There are pros and cons to that. The pro being that you certainly conserve your principal. It's not going to go anywhere unless it's stolen.
But that's right. It's also not going to go anywhere.
But the downside is, in essence, it is going somewhere, and you are losing money over a period of time when you compare that to inflation. So you do need to put your money to work for you. And that's really the beauty of the market that we're in now, and where we've come over the course of the past 10 or so years with some of the instruments out there in the investing world that can help you protect your portfolio, much in the same way, not exactly the same, but much in the same way that we take out insurance on a car, or we take out insurance on a home, or we take out health insurance. We have those to protect against the downside that could be experienced due to an emergency or some sort of a freak accident. That same type of protection or similar protection is available in the market to help protect your portfolio. The problem is that a lot of people just are not aware of it or have not used it in the past or view it as risky because they don't understand it, so they just push it off to the side and ignore it completely.
Yeah, you can definitely set many different stop gaps, things to keep to manage your investment on a day-to-day basis, even if you're not on top of it every hour.
Right, and even if it's something that you're not doing, it's certainly something that your advisor can be doing for you. And what I'm speaking about primarily are the use of options and futures, as a protection against your portfolio, which most every larger institutional fund, that's what they're using to protect their portfolio. Why can you not use it as well? And if it's something that you're not exactly savvy with, it's not that you have to go jump all in, but it's certainly a question you can bring up to your advisor and see if that, is something that they can help you out with. And it's no different than think about a farmer who's got a field full of crops, and they want to protect the price of their corn that they're going to sell on the market against fluctuations in that price.
Right.
They don't want to just absolutely let it stay there and move with the market.
That would be a bad idea.
So if they want to protect the price, they can protect it using futures on corn.
Yeah.
So it's just the same concept, the same theory. So, there's a lot out there now to where, investors can really have a professional institutional advantage in today's market with very little work required that they wouldn't necessarily need or there shouldn't be an environment other than a 2009 to where you are in all cash.
Right. All right, I have an odd question, and forgive me for my ignorance on this one perhaps, but I know that there are certainly times, especially when the market is going crazy, like when people are, selling, everybody's selling out or everybody's buying in, where just the simple fact that people are moving the market directs the market. So it has a sort of a,
right.
It creates its own effect, so to speak, a self-fulfilling prophecy, if you will. The market doesn't have as much of that anymore. If I understand it correctly, because of so many of the different instruments that are being used now. Would you not agree with that? It has a little more of a stable feel anyway.
It certainly has more of a stable feel. I don't know if I would necessarily say that it lacks the volatility that it once had. I certainly think it's more volatile now than it's ever been.
Right.
And I certainly think there is a directional bias based upon who's buying, who's selling, how many people are buying, how many people are selling.
It's still there.
One thing, it's absolutely still there. One thing people need to understand, about 75% of the daily activity in the market is driven by large institutional professional players. Mm-hmm. The Morgan Stanleys, the Goldman Sachs, some of the largest hedge funds, the algorithmic traders. Those are the people that are driving the market on a daily basis. Those people are also the first to pull out of a market because they're day traders. They're trading it primarily, intraday.
Right.
They're the first to pull out as well. Now, if 75% of the market liquidity pulls out of the market,
wow,
you could see a massive swing, right?
Yes, you would definitely.
So with that said,
that's what makes it
to
more
your
volatile.
point, it's absolutely, in my opinion, more volatile than it's ever been, and you could certainly see far more volatile swings because of that. Because again, they're not in it for the long term. They're playing, they're trying to make a quick profit. If the environment is not conducive to what they want to see, then they're going to pull out of the market.
Sounds like I want somebody watching that all the time for me.
You definitely want someone, if you're playing in the market and you're trying to play short term, you want some help. You want someone, if you can't watch it 24/7, you need someone helping you out watching it. But again, most of the folks that we're talking to, your long-term plan is in place. You shouldn't be as concerned with the daily moves, the daily volatility that the market experiences. And again, for the older generation, it's difficult right now, and I understand that. But there are tools out there to help you. So if you do have a financial advisor, ask that advisor about some of the protection that you can put in your place in your portfolio, right. So you're not just sitting in a CD at a local bank, making a couple basis points on your money. At least try and make something, because a lot of us are still trying to play catch up from the past crisis.
Yeah, we're just trying to get back some of the money we lost.
Not everyone was perfect timers and bought the dip in 2009 and have made the entire run up. So, you have to be out there putting your money to work.
Well, keep an eye on the Goldman Sachs for me, okay?
Yeah, absolutely.
I appreciate it. As always, Travis McGhee.
Yep.
Keeping an eye on the market for all of us. Of course, if you need somebody to do that for you, that's a great place to go. And we've got his website up on the screen here again in just a second. And of course, thank you very much for being here as always. Yeah, it's great to have you.
Absolutely.
And we'll look forward to seeing you next week.
Definitely.
All
Thank you.
Well, we will be back with more right here on the Mountain Morning Show. We've got everyone from, of course, speakers, lecturers, and more. It's all here on the Mountain Morning Show after this.